Welcome to Investing Insights. I'm your host, Ivana Hampton. The struggle of brick-and-mortar real estate has extended into investment portfolios. Elevated inflation and high interest rates have weighed on the real estate sector over the past few years. And real estate investment trusts, or REIT ETFs, have not been spared. Yet these exchange-traded funds are popular among income investors. They can generate cash and can help diversify a portfolio. So where do they fit in yours? And which REIT ETFs do Morningstar analysts consider top picks? Dan Sotiroff is an Associate Director of U.S. Passive Strategies for Morningstar. Dan is also the editor of Morningstar's ETFInvestor newsletter. Thanks for joining me, Dan.
You're welcome. Good to be here.
Let's start with an explainer. What is a real estate investment trust ETF or REIT ETF, and how do they work?
Right. So you got the acronym right. REIT is just an acronym for Real Estate Investment Trust. The way to think about these is these are, in the context of a REIT ETF, they are publicly traded companies that invest, operate, finance real estate. So they have some exposure to like an underlying property, and that can run a wide range of different properties. So it could be things like shopping malls, office centers, even now you're starting to see like data centers are a big item. So data centers or warehouses, those are another one. And then cell phone towers is kind of another new niche category in here. But it's basically the underlying property and the economics of that property that they're exposed to. So that's the best way to think about it. The other way to think about it is like if you're a landlord and you own like an apartment or a house that you're renting out, it's sort of like that, except you're sort of outsourcing the maintenance and all the upkeep and having to keep track of tenants and leases and all that stuff. You're outsourcing that to a company to do all that work instead of doing that yourself.
So it's a time saver too.
It's a time saver, yeah.
So what makes REITs different than other stocks?
So there's some differences in the way the companies are organized and some rules around how they operate. So REITs get a little bit of a tax break. They don't have to pay taxes on a lot of their income. The caveat is they have to distribute most of that income or that profit to end investors as income. So the tax is still getting paid to the government. It's just the burden is put onto the investors at the end of the day rather than the company. So that has some implications for sort of their businesses and how they finance their activities and stuff like that. But that's probably the biggest thing that you have to keep in mind. And that's a big reason why there's such a magnet for like income investors is because they throw off a lot of income. They have high yields. But remember, it does affect the underlying economics of the business in some way.
What type of strategies do REIT ETFs typically use?
So like any other sort of investment, you have your high-level active and passive variations. Passive funds can focus on REITs specifically. So there might be a specific REIT index that an ETF tracks or something like that. There are some that are a little bit broader. So they'll hold mostly REITs, but then they also hold some real estate adjacent companies. So if you think like Zillow and CBRE Group, those are real estate companies, but they don't actually have exposure to underlying properties in some way. They're doing something else. There's a different business model going on there. So some indexes are a little bit broader and they may sweep in those companies. So it's a little bit of a distinction at the margins. On the whole, most real estate ETFs are probably going to focus on, at least the index tracking ones are probably going to mostly focus on REITs. When you get into the active space, it gets a little bit different because active managers can kind of paint outside the lines a little bit. So they may hold some other companies like maybe like casinos or something like that, where real estate is a big part of the business, but they're not actually a real estate company per se. So you may see some active funds that drift outside and hold some stocks from other sectors that are kind of real estate adjacent, let's say.
Let's talk more about active ETFs because we have the active ETFs, we have the passive ETFs. Are the higher fees for active REIT ETFs worth it? What are income investors paying for, Dan?
Yeah, so it depends on how you look at it. So when we do the high-level active-passive barometer sort of like scoring on these things, we do see that active managers do have a little bit higher success rate in the real estate category. It's higher. It's not like hugely higher or anything like that. You're still going to have to do some homework if you want to go with an active manager in this category. The thing to watch out for is where is the performance coming from? So even if they outperform, like, are they painting outside the lines and going after these non-REIT companies? Because the total return may not look great, but if you're really after income, the fact that they're going after non-REIT companies means that their yield may not be as high. So there's a balance you're going to have to play there and really have to focus on, like, what are you actually after? Are you actually after total return, or are you actually after income at the end of the day, and make your decision accordingly?
Are there any underlying characteristics that differentiate some funds from others?
Yeah, so we already kind of talked on how Active managers can kind of paint outside the lines. As far as index tracking funds go, again, it's what are they holding? So is it a REIT focused index, or are they a little bit broader? Do they have a slightly bigger opportunity set where they go after the entire sector and maybe own like a Zillow or something like that? Those are going to be like the biggest differentiators probably across the board in terms of like nuances to pay attention to.
Let's talk about performance. How have REIT ETFs performed?
So let's break this down into two things. We'll do the absolute and then the relative. The absolute doesn't look bad. So if you look long term over the last 15 years, that's roughly post GFC up to present. Total return isn't terrible. It's a little over 7 percentage points a year, which not great, but not terrible either. You still made money. When you compare them to the broader market, though, they underperform by about 6 percentage points a year over that period, which, yeah, I feel like I just took the air out of the room here, but yeah, it hasn't been good. And the reason for that is it's like, look, we've been in this market cycle now for almost 15 years where it's basically been dominated by tech companies. It was dominated by tech companies, from about 2013 onwards. It's still dominated by tech companies with all the AI and innovation stuff that's going on right now. So real estate has just really, really had a rough time over the last, 15 years or so. It's been tough, but yeah.
We're going to shrink the window here because the years-long fight against inflation pushed up interest rates, created a challenging environment for the real estate sector. The Federal Reserve is holding rates steady after 3 rate cuts last year. What has been the performance of REIT ETFs versus the broader stock market since 2022?
Yeah, so you bring up a good point in general, which is that REITs are very sensitive to interest rates, right? So if you think about how they're structured, they have to return a lot of that income to, or a lot of their profits to investors as income distributions. So that means they don't have those retained earnings to go buy new properties or reinvest in their business. So they have to finance a lot of their activities. And that means that their cost of financing is going to be closely tied to whatever the prevailing interest rate is at the time that they take on debt or loans or whatever. So they're going to be very sensitive to the interest rate cycle. And we've seen that over the last 4 years. They've done really, really terrible over the last 4 years. They lost about 2.8 percentage points over the 4 years through December 2025. And a lot of that, I think you can tie back to interest rate changes. 2022 was when inflation started ticking up and we saw interest rates increase, like you said. They've underperformed the broader market by about 13 percentage points over those years. So not only do they lose money, they really, really underperform the market. So yeah, it's all kind of in line with what you would expect from this type of asset class with the interest rate sensitivity. And I think it's pretty easy to wrap your head around, right? We saw interest rates increase, we saw mortgage rates increase over the same time, and it's the same dynamic that we see going on here. It's just it's on a much broader scale outside of just your personal home or something like that.
Now, income is the name of the game with these funds. How can income investor minimize their tax bills? And what's the best location to hold these investments?
Yeah, it's not rocket science on this one, right? Like you got to put these in a tax deferred account if you're going for the long-term growth where you're going to be reinvesting the dividends to hopefully help that investment grow as big as possible over time. So tax deferred account, for sure. So like IRAs, 401ks are perfect. I tend to think a lot of people are investing in this for income purposes though. So in that case, it's like you're kind of on your own. There's no way to like get crafty and avoid the taxes on this. You're going to have to pay income taxes if you take the distributions. So unfortunately, that's just the way it works.
Be prepared for the 1099.
Yes, exactly.
Let's discuss the different types of REIT ETFs and what Morningstar analysts think of them. First up, broad-based ETFs. What will investors generally find in these funds and which earn a silver or gold rating from Morningstar?
So we'll just kind of take them in order of like biggest to smallest. Vanguard Real Estate ETF is kind of the Goliath in the category. The ticker is VNQ, has about 35 billion in the ETF share class. And that has a silver rating on it right now. We like it a lot within the category. A close cousin similar to that one is the Schwab US REIT ETF. That one focuses strictly on REIT. So we were talking about the differences between different indexes before. So the Schwab ETF, SCHH, that's going to be strictly REITs. The Vanguard one is one of those ones that's a little bit broader. So it's going to own some of those real estate adjacent companies. But the Schwab ETF, 9 billion, still a pretty big REIT ETF in the category, also has a silver rating. That silver tends to be the highest for a lot of the index tracking funds in the category. So those are both index trackers. Great option if you want to start out just getting into broad real estate as an investment. The third one on my list here is kind of an actively managed one. It's the Dimensional Real Estate ETF, about $1.5 billion. The ticker on that, I believe, is DFAR. It's a little more active than the previous two. It's going to be index-like, but the active side of it is going to be how they trade in and out of positions in that portfolio. So they're trying to give you just broad exposure to real estate investment trusts, but they're going to be a little bit more slower to trade than some of the indexes are. And there's some advantages to that at the end of the day. But those are the big ones. A lot of the active funds that we rate in the category are actually mutual funds. So we don't have any ETFs that we're rating right now that I can share with you. But those, if you're looking at strictly ETFs, those are probably the three I would start with.
If an income investor wanted to focus on U.S. real estate, which funds are doing well in that area?
So start with some of the three above that I kind of mentioned. They're all cheap, cover REITs pretty well. Like I said before, the Vanguard one is a little bit broader. It's going to go into some of those non-REIT type real estate companies. They're going to give you the risk return of the real estate sector, which is a good place to start. And I always tell people, like, if you're trying to figure out how to get into something, like, start with the broad index, and then as you learn about the risk return of and how the nuances of the category or of the sector or whatever it may be in this case, then you can start to look for active managers and start to understand maybe where they can gain an edge and where they can maybe fall short in some regards. So that's where I would start, is really just go broad and really, because you're just cutting fees. I mean, at the end of the day, those three that I mentioned are probably some of the cheapest in the category too. So you're going to be well off from a fee perspective.
What if you want to invest in real estate outside the U.S.?
Yeah, there are options for that. We have a completely separate category, a global real estate category, where we keep broad global funds that are U.S. and international. And then it also holds just international ETFs. So if you want to go outside the U.S., my sort of starting point recommendation is the same. Start with the Vanguard Global ex-US Real Estate ETF. The ticker on that is VNQI. Broadly covers the real estate sector outside of the U.S. And a lot of the rules around like how real estate works outside of the U.S. are very similar to how they work in the U.S. So that, they have to take roughly 90% of their earnings and distribute that. That still applies to a lot of international markets as well. So the experience is going to be similar. You're going to get some additional risk with the foreign exchange and different interest rate environments and that sort of thing. But the concept, at least, is the same.
We can rest on the concept. So what is the takeaway for income investors considering adding REIT ETFs to their portfolio?
So I think we went through a lot of the big basics. The other thing I would really point out to people is to really be careful about how you allocate to these things. You have to remember that real estate sector is really kind of a small niche segment of the overall market. It's somewhere in the neighborhood of like 2 to 3%, depending on market dynamics. So just be careful. If you're taking on like a really big allocation to this, you're making a pretty big bet against what the market says the weight of this sector is. So just be cautious about that. That may help you depending on the environment they're in. Past 15 years, it hasn't helped you though. So just be careful in that regard. There are, the alternative to this, we've covered some of these in previous videos, is like you can get dividend paying strategies or covered call strategies or something that are much broader and cover the overall market that aren't going to be making these big sector bets like REITs are going to. So just a few things to keep in mind, I guess, as you're considering these.
Well, thank you for the tips, and thank you for coming to the table and discussing REIT ETFs, Dan.
Oh, you're very welcome.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you, and subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Shake Van Kersen and associate multimedia editor Jessica Bebel. I'm Ivana Hampton, lead multimedia editor, Morningstar. Take care.